Hi, in this video, we'll continue to look at the return and the risks for portfolios that combine risky assets with risk-free assets. So from the previous video, we have proven that such portfolios' risk is only proportionate to the risk of the risky assets here. So that's the weight of the risky assets multiplied by the risk of the risky assets here. So it has nothing to do with the risk-free assets here. Right, so we've already dealt with the risk part, but we haven't really looked at the return here. So let's write the return of such portfolios. So the expected return is going to be the weight for the risky assets and the return for the risky assets plus the weight for the risk-free assets multiplied by the return of the risk-free assets. Okay, so let's rearrange this equation so we can substitute out the weights here. Okay, so let's just put sigma k to the left-hand side. So we have sigma p divided by sigma k is going to be your wk here. Okay, let's substitute this part out using our sigmas here. So sigma p divided by sigma k multiplied by rk, which is your risky assets return, plus WF and RF. And remember, we're only having two different kinds of assets here, so the weights for both assets should always add up to 1. So RF here can be further substituted out using 1 minus WK here. So let's keep it that way. Sigma P, sigma K multiplied by RK plus 1 minus WK here multiplied by RF. And again, the WK can be substituted out using the sigmas. So we can further simplify this. Okay, so we have sigma P, sigma K multiplied by RK plus 1 minus sigma P divided by sigma K and multiplied by RF here. Okay, so we can further simplify this expression by a little bit because we have this term here, which is the common factor, right? Let's pull this thing out. So we have 1 times RF, which is just RF. Let's put it aside. And plus this thing here minus this whole term here. Okay, let's collect the terms. So it becomes sigma P, sigma K, and then RK minus RF here, right? So we'll just rearrange a little bit so we can see it in a clearer way. So we have RF here plus RK minus RF, okay? The whole thing divided by sigma K and then multiplied by sigma P here. Okay, so this is the final form that we're looking for. So what does this thing tell you, or what can we learn from all of this stuff here? It means that the return for such portfolio is a linear relationship between its risk. Okay, so the risk here, sigma P, is in a linear relationship with the return for the portfolio here. Why? Because we have this thing here, RF, which is given, so it acts like an intercept, and this thing here, they will act as if like a gradient here. Okay, so this will be a number or a coefficient. So what do we have here? This expression is called the Sharpe ratio. Okay, we call it the Sharpe ratio here, which is RK minus RF divided by sigma K here. So it has a specific name. So what is the intuition behind the Sharpe ratio? So this bit is your risky assets return. This bit is your risk-free assets return, and this is your risky assets risk. So we're basically calculating how much of the return are we getting above the risk-free rate per unit risk that we're taking, right? So it's a per unit measure of the risk premium for your risky asset here. And this is called the Sharpe ratio. So we're sort of min-maxing the risk and the return here because we're on a per unit of risk basis here. Okay, so from this we can conclude that for any portfolio that combines the risky assets and risk-free asset, the return of which is in a linear relationship with its risk here, and the gradient is the Sharpe ratio, and we would love to have a higher Sharpe ratio because due to the per unit measure of per unit of a risk measure here, we would like the higher return. So for the same level of risk, we would love higher returns here. So the higher the Sharpe ratio, the better the min-max relationship here would be, right? So in the next video, we're going to express this on a graph so we can see it in a more intuitive way. And I'll see you there.